welcome to Credit Compass, your guide to navigating European credit markets. Well, here we go. From one week to the next, we have flipped again on the outlook for inflation. With the Strait facing renewed conflict and commercial ships being attacked, we are back to a challenging inflation picture. We will dig into that a little more deeply. Also, as we head into earnings season, we thought it would be a good idea to look at the second half outlooks from a number of large investment managers. Expectations vary, but the broad consensus centers on Europe's exposure to the energy situation and its sensitivity to growth. Nonetheless, expectations are for an expansion in credit as the investment and CapEx story continues from AI to infrastructure. All right, let's dig in. Let's start with the topic du jour. The Strait is shut again, or is it? A number of articles have come out recently suggesting that more traffic managed to transit the Strait during the supposed shutdown than official figures indicated. Some vessels reportedly switched off their transponders, while others made use of dark shuttle operations that avoided the Iranian coastline. There has also been an increase in alternative Gulf supplies, including Saudi exports through Yanbu, with estimates of around an additional 3 million barrels per day running through that route alone. Other alternative routes in the Gulf have also helped to replace some of the trapped barrels. Add to this increased production from the U.S., Brazil, Venezuela, and Kazakhstan, and you start to see a proportion of the block supply being replaced. Alternative supplies of refined products have increased as well. For example, higher jet fuel refining in Nigeria contributed to West African jet fuel supplies doubling from their preceding 3-month average. This is all positive and may help explain some of the cap on pricing that we have seen. However, the overall level of flow will still be muted compared to with normal conditions, and pricing pressures have resumed. Even though we are already tired of discussing it, the situation presents real challenges for Europe the longer it continues. It is fed directly into inflationary pressures, as we have already seen in April and May, and a slight relief as energy pricing eased in June. The longer the conflict continues, the greater the risk that it carries forward into more persistent inflationary impulses. Europe's reserves have been diminished by seasonal energy demand and by efforts to release additional reserves to avoid a larger spike in pricing. As a result, inventories are particularly low at the moment. This is the period when we should be refilling those reserves, which we are now doing at a time when prices remain elevated. That affects future pricing and risks keeping everything elevated as we head towards the winter period. This is what we had hoped we had avoided with the Memorandum of Understanding and the ongoing negotiations. Now it looks as though even if we get another cessation of kinetic activity, it is likely to be short-lived. The relief for yields may therefore have been premature. Now, what do the big investment managers think? As we head into the second quarter earnings season, it is worth looking at expectations for the quarter and the remainder of the year. With the help of my intern Evelyn Liu, we have gathered the second half outlooks from a number of large investment managers. The clearest message from those outlooks is that Europe is caught between a weak cyclical backdrop and a potentially powerful structural investment cycle. In the near term, the region remains vulnerable to energy shocks, as we have just discussed, coupled with fragile household confidence and pressure on real incomes. All things we agree with. Several managers describe Europe as lagging the United States because consumers remain cautious. While higher energy costs can feed quickly into inflation, corporate margins, and household spending. Again, not a major revelation, and we agree. Yet this is not a bearish European story. The more constructive case rests on a transition from consumption-led growth towards investment-led growth, supported by defense spending, energy security, grid modernization, transportation, digital infrastructure, and broader strategic autonomy initiatives. This is a theme we thought would have emerged already, were it not for a certain blockage in the Gulf. That divide between weak consumption and stronger capital expenditure is the first broad theme. The outlook for the second half is selective rather than uniformly positive on Europe. Consumer-facing and energy-intensive sectors appear the most exposed. Industrials, utilities, infrastructure, financials, and business connected with the electrification or physical artificial intelligence infrastructure are viewed more favorably. The strongest borrowers may increasingly be those linked to long-term public and private investment programs, rather than those dependent upon broad domestic consumption. The second major theme is that European inflation is expected to remain volatile, particularly because of energy. This week has proved a prime example. The outlooks do not broadly present Europe as returning cleanly to the low inflation environment that prevailed before 2020. Higher energy prices, defense spending, supply chain fragmentation, and fiscal investment could all keep inflation elevated or unpredictable. Again, these are all themes we agree with, but they appear to have been improving before last week. This leaves the European Central Bank with less room to deliver further easing and creates less predictability around short-term rates. Fidelity and Deutsche Bank emphasized the possibility of further tightening, while BNP Paribas Asset Management appeared more reassured by recent signals, suggesting that additional rate increases may not be necessary, although I expect that this tone, along with everyone else's, may have changed slightly this week. The central area of contention is therefore not whether monetary policy is constrained, but how severe and persistent inflation becomes. The divergence over ECB feeds directly into the government bond outlooks. BlackRock prefers short maturity euro area sovereign debt, where yields can provide income with less sensitivity to long-term inflation and fiscal uncertainty. Other managers identify opportunities further along the yield curve, including the possibility that bond yields decline if growth weakens or geopolitical and energy pressures ease. Longer duration bonds could perform well if disinflation and slower growth reassert themselves. However, they remain vulnerable if inflation stays elevated or if Europe's investment agenda requires materially heavier government borrowing. The consensus is therefore not a blanket recommendation to extend duration. It is a case for active, curve-aware positioning that distinguishes among short, intermediate, and long-dated exposures. European investment-grade credit is the most consistently supported area of the fixed income market. Amundi favors European investment-grade bonds. Deutsche Bank sees euro-denominated investment-grade credit as relatively well supported, and BNP Paribas Asset Management prefers credit income to outright duration exposure. The attraction is primarily carry, the income earned from holding a bond. Investors can receive comparatively attractive yields without relying entirely on central bank rate cuts or falling government bond yields. Demand from income-oriented investors is increasing, and the generally stronger balance sheets of investment-grade issuers also provide support. However, this is where another important area of contention emerges. PIMCO and Fidelity warn that credit spreads are tight, meaning that investors may not be generously compensated for taking additional default, downgrade, or liquidity risk. BNP Paribas Asset Management and Deutsche Bank are more constructive, but their optimism is concentrated in higher quality credit rather than indiscriminate exposure. The practical synthesis is that European credit remains investable, but security selection matters more than broad market exposure, something we have highlighted on numerous occasions this year. Balance sheet strength, cash flow visibility, refinancing requirements, covenants, collateral, and liquidity compensation all become more important when tight spreads leave little room for disappointment. European high yield is consistently viewed with greater caution. Its carry can still be attractive, but the outlooks identify vulnerabilities among real estate, automotive, and consumer-linked issuers. These sectors are particularly sensitive to elevated funding costs, weak domestic demand, and margin pressure. The implication is not that European high yield should be avoided altogether, but that it requires a defensive approach and detailed issuer-level analysis. A final theme is the changing role of Europe's capital markets. The scale of proposed investment in defense, energy infrastructure, electricity grids, storage, transportation, data centers, and industrial modernization could expand both sovereign and corporate bond issuance. Private credit, infrastructure funds, banks, and blended finance vehicles may also assume a bigger role. This creates a potentially broader fixed income opportunity set, but it also introduces execution risk as supply increases. That carry demand does provide support, but Europe must convert policy ambition into funded projects, credible revenue streams, and investable securities. Fiscal constraints, political disagreements, permitting delays, and uneven implementation could prevent some of the anticipated investment from materializing. Taken all together, the outlook points towards a European fixed income market that is becoming more important, but also more differentiated. The strongest common case is for income-oriented strategies built around short maturity, sovereign bonds, and high-quality investment-grade credit, with selective use of duration where inflation and fiscal risks are adequately compensated. Credit remains attractive as a source of yield, but tight spreads argue against simply buying the entire market. The direction of travel is towards active management, careful selection, a greater attention to the relationship between macroeconomic policy and Europe's structural financing requirements. The central takeaway for us is that European fixed income may offer a more coherent opportunity than broad European equities during the second half of 2026. But the thesis is not simply that Europe is inexpensive or that interest rates are about to fall. It is that higher yields, expanding financing needs, and a multi-year capital investment cycle are creating new sources of income, provided investors remain disciplined about duration, credit quality, liquidity, and sector exposure. So, what will we be watching for as companies report earnings in the coming weeks? Well, these are second quarter earnings, so they will have been heavily affected by the first Strait of Hormuz closure. As a result, the focus will be on margin compression, where companies able to pass through price increases. Were supply chains adjusted to compensate for the closure? Was there a buildup in inventories as the result of the situation? Did higher prices result in demand destruction? The sectors likely to have been most heavily affected are the consumer-facing segments of the market and those with higher transportation costs. Further, the chemical sector will have had some winners and some losers as a result of supply challenges. And looking forward, given the comments from investors, it will also be important to see what is happening with CapEx investment. We have seen an uptick in manufacturing PMIs and factory orders. Do companies expect that to continue? We will update you with more important elements that we find as the results come through, as always. That is all for this week's edition of Credit Compass. You can find these and other reports on macro and credit trends by visiting kbra.com/macro credit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.